Welcome back to the channel where today we delve into Nvidia, NVDA, one of the hottest stocks on the market. With earnings on February 26, 2025, investors are left pondering whether to dive in now or wait. The anticipation is palpable as Nvidia continues to forge its path as a titan in the AI and semiconductor space, setting the stage for lively discussions on its financial prospects. As we approach the earnings report, Nvidia's financial outlook is a topic of great interest. The company is expected to unveil revenues of $37.5 billion, a notable increase from $22.1 billion last year. While this reflects robust growth, it also exhibits a slowdown compared to last year's staggering 265% year-over-year increase. The underlying concern revolves around whether the momentum can be sustained amid changing market dynamics and increasing competition from cheaper alternatives. Nvidia's profitability is another critical angle. With gross profit margins projected at 73%, slightly down from last year's 76%, it raises questions about the company's pricing power. The launch of the new Blackwell chip series has led to initial lower margins, but predictions suggest a recovery to 75% as production scales up over time. The uncertainty lies in understanding the impacts of supply constraints, geopolitical tensions, and how competitors are positioning themselves in the market, particularly with threats like China's DeepSeek innovating in low-cost AI models. The landscape of AI competition is shifting rapidly, with tech giants ramping up their spending on AI projects. Despite concerns over cost-cutting due to emerging competitors, the movement toward AI integration remains strong across platforms like Google, Microsoft, and Amazon. Nvidia's robust ecosystem, coupled with the unmatched performance of its Hopper and Blackwell GPUs, keeps it firmly rooted in a commanding position. Yet, this leads to the question, should investors seize the opportunity now before earnings or remain cautious? Ultimately, the decision hinges on individual risk tolerance and belief in Nvidia's long-term potential, amidst a challenging yet exciting landscape. Adequate due diligence is crucial as we dissect these earnings and strategize potential moves for investment. By analyzing Nvidia's position and growth trajectory, investors can better navigate the turbulent waters of stock investment ahead of this key financial moment. As we move deeper into the digital age, artificial intelligence has become a cornerstone of technological advancement. Major tech companies are significantly ramping up their AI budgets, indicating a bullish market for AI-related stocks like Nvidia. Google plans to boost its spending from $50 billion to $75 billion, while Meta Platforms is charting a similar course, increasing investment from $39 billion to $65 billion. Microsoft is also not lagging behind, soaring from $50 billion to $94 billion, with Amazon projected to grow its budget from $75 billion to $90 billion. These hefty investments signal a robust demand for AI technologies, a key driver that will undoubtedly benefit Nvidia. Nvidia, already a dominant player in the AI chip market, boasts an impressive market share of 80–90%. This enhances its position as these tech giants invest in AI solutions that rely heavily on powerful computing capabilities. Nvidia's GPUs have become essential for various AI workloads, meaning that as investment in AI grows, so does the demand for Nvidia's hardware. The company's data center revenue reflects this acceleration, with a staggering 112% increase reported last quarter. Notably, cloud service providers contribute to 50% of Nvidia's data center revenue, further underscoring the growing reliance on AI-powered infrastructure. However, uncertainties loom over Nvidia's ability to meet skyrocketing demand for its GPUs. The Hopper GPUs from the current generation are flying off the shelves, while the eagerly awaited Blackwell GPUs are already sold out for several quarters ahead. Investors are keenly observing whether Nvidia can maintain this demand and pondering the implications of emerging competitors like AMD, along with custom AI chips from tech rivals. Also critical is the company's ability to expand production to meet this surging demand. Although Nvidia's forward P/E ratio of 24 appears relatively low for a rapidly growing company, it hints at caution in the market regarding sustainability and growth. Despite current valuation concerns, Nvidia's intrinsic value points towards a compelling investment opportunity. With a solid footing in the AI sector, Nvidia remains a stock to watch as it emphasizes the importance of innovation and agility in this fast-evolving market. Investing in Nvidia offers enticing opportunities, yet it also comes with notable risks. One critical risk is supply constraints. Although Nvidia's GPUs are in high demand, manufacturing limitations could hinder potential revenue growth. Investors eagerly await news of Nvidia's production expansion to meet this surging demand, understanding that any hesitation may restrict the company's performance in a competitive landscape. In addition to supply issues, increased competition poses a significant threat to Nvidia's market dominance. Giants such as AMD and Intel, along with tech powerhouses developing custom AI chips, are gradually entering the space. Industry leaders like Google and Microsoft are innovating their own AI solutions, potentially diminishing Nvidia's stronghold in the GPU domain. This evolving competition drives investors to reassess their faith in Nvidia's long-standing superiority. Geopolitical risks further complicate the investment landscape. Recent U.S. government restrictions on AI chip exports to China directly impact Nvidia's sales strategy and revenue. Though the company has adapted by introducing weaker AI chips for the Chinese market, the looming concerns about revenue loss remain unsettling for investors. The complex political climate could send ripples through Nvidia's financial stability, and long-term investors must keep a watchful eye. Valuation concerns elevate the stakes. Even amidst impressive growth, apprehensions linger that Nvidia's earnings could peak and eventually decline, especially if AI demand experiences a downturn. A sharp decline in valuation could catch investors off guard, prompting a need for serious due diligence before any investing moves are made. As earnings reports approach, the volatility of Nvidia's stock intensifies, resulting in a pivotal moment for potential investors. In light of these risks, formulating a well-considered investment strategy is essential. An aggressive approach may reward those willing to invest 75% before earnings, while conservative investors might favor a split investment of 50% before and 50% after earnings. Each approach reflects varying levels of risk tolerance, emphasizing that the path taken should align with individual investment goals. In conclusion, while Nvidia stands out as a leader in AI and semiconductor technology, navigating the potential risks is crucial for investors. The landscape shows promise, driven by increasing AI spending from other tech firms, but also uncertainty. Deciding whether to buy before or after earnings requires careful consideration of the associated risks. Regardless of the strategy chosen, preparedness for volatility will be key in maximizing potential gains.